Hi, welcome to Numerix Video Blog. I'm Jim Jockle, your host. Today we're talking about structured notes. Last week, Bloomberg reported that the U.S. note sales in the quarter is going down as volatility falls, citing the impacts of quantitative easing as well as the uncertainty around the November elections. And looking at the product mix as well, nothing's really changed in terms of equities issuance of structured notes, dominating about 61.5% of the market, with a little bit of an uptick in inflation risk. With me today to talk about product specifics is Tim Mortimer, Managing Director of Structured Edge and FVC. Welcome, Tim.
Thank you very much.
Tim, looking at structurededge.com, wanted to talk a little bit about the product mix. So looking at year over years, clearly reverse convertibles are dominating in terms of the numbers of issuance, but moving down the league tables in terms of the notionals outstanding. And most notably, the rise in leverage return notes this year. Why don't you give us a little bit of a walkthrough of the profile of a leverage return note and what's facilitating the issuance this year?
Sure. Well, leverage return notes in the US have been one of the most popular and sort of reliable product type over the last couple of years, and is always at or very near the top of issuance. The typical profile is linked to the S&P or maybe the Russell 2000, of maturity somewhere between 1 and 2 years, some kind of downside protection, maybe a 10% buffer or a barrier, and then leveraged upside, so perhaps 2-for-1 upside up to a cap, wherever the pricing determines that. And so it's quite a good each way bet really for investors looking to capture some upside, maybe repair bear market losses, or just look to outperform the index in a modest index growth scenario, with a cap level set at maybe 10% per annum, which is something which they'd be quite happy to end up with as a maximum return, and therefore provides upside with some kind of downside protection. So it always has validity. The pricing also actually is fairly invariant to different pricing situations. Many product types, if volatility moves or interest rates move, they either suddenly become very attractive or unattractive quite quickly. Because of the nature of the leveraged return note, it actually is less sensitive to parameter changes, so it's always can be put out there.
And in terms of length of maturity, what's the general term on these types of notes?
Between 1 and 2 years, maybe 1.5 years on average. So
also fitting in with investors' profile of not wanting to be locked up for long periods of time.
Yeah, exactly. The way the product works, it doesn't need to be excessively long dated in order to get participation rates, such as principal protected return notes have to have long maturity to make them work. The leverage ones don't. So you can keep it to a fairly simple structure, time some kind of medium-term market view, and then, as you say, cash the proceeds and try again.
Two other movers on the league table year over year, review notes and bonus structures. Quick overview and what's facilitating the movement of issuance.
Sure. The review note, which is popular actually all over the world, particularly out of Europe and Asia, that is a product which has some kind of target annual return, with the ability for the product to auto-call or automatically end if market conditions are right. And usually that means that the index is up after a certain either monthly or annual review dates compared to its starting level. It's actually similar to kind of cross between a leveraged return note and a reverse convertible. You lock in some target return if conditions are right, then you're free to reinvest. So I would say that really has become more popular because other product types are less compelling at the moment with the way the pricing is. The bonus structure has always been popular in Europe, and for some reason has caught on here. Maybe the payoff shape with a bonus return, which is paid if market conditions are reasonably favourable, with some kind of downside protection built in there. So it's not surprising to see those two there.
And in terms of underlyings, looking at the site, clearly the standard list of names that one would expect on the indice products. Two that kind of came up as popular underlyings, Apple, Halliburton. How is that floating into these types of products?
Well, the reverse convertibles in the US have traditionally been single stock linked, very short dated, and with very high coupons. And that they're linked to different stocks, either from some kind of reverse inquiry process where the client has specified the different stocks they want to have products linked to, or it's just to provide a range of underlyings and a range of different coupons and risk profiles. That also explains why reverse convertibles, there's a large number of products out there, but each of them with relatively small notional size. So as a notional percentage of the market, they tend to lag behind the accelerated leverage return notes. Apple is always a good choice because consumers, investors identify with it, and the volatility and its prospects give a reasonable return for the risk taken on.
Excellent. Well, thank you very much, Tim. I appreciate your time. Hope to see you in this chair again, especially as we come around to the end of the quarter and we can look at performance, especially with some of those economic barriers potentially at least being removed or at least worked out and knowing where the market will go forward. That'll conclude today's video blog. I would like again to thank Tim for joining us. Visit us and chat back with us on Twitter or on our blogs at Numerix.com. Have a great afternoon.